David Rosenberg tracks all of the numbers tied to the economy and the stock market, and he joins us this morning from the TSX. He's the chief economist and strategist at Gluskin Sheff and Associates. David, thanks as always. Nice to have you with us.
Thank you.
So I know that you've been raising red flags around what the economic outlook appears to be from your perspective for a while. This week, though, the market's really So this week, though, the market's really paid attention to this manufacturing worry, and then we saw this really steep sell-off. So what do you make of the dynamics at play here?
Well, I certainly think that that manufacturing ISM index in the United States was certainly an exclamation mark on the fact that the industrial sector is headed into a recession. I mean, after all, the headline was the lowest it's been since the spring of 2009, which was really at the depths of the Great Recession. And of course, the data overseas have been anywhere between horrible and lousy, whether you're taking a look at the numbers out of Asia and especially the numbers out of Europe, Germany in particular. So it's not just the US, it's really been this raft of very weak global economic data. And then you layer on top of that, the spreading global trade frictions, no apparent improvement in these talks with China. And in fact, what had me unnerved going into the weekend last Friday, was the news that the administration is considering putting limits on Chinese company listings on U.S. exchanges. So all of a sudden, it's no longer just a war on the trade account. It is now a war on the current or the capital account. So, and you just add on all the other anxieties, the impeachment proceedings. The reality is that the UK could be tiptoeing into the hard Brexit by the end of the month. All these things are leading to anxiety and angst and uncertainty, and a pullback in the market multiple across every equity space on the planet. That's really the story right now.
And to your point, it's not just the sell-off we saw in the U.S. markets or on the TSX this week. I mean, you mentioned Germany, which over the last 2 days has seen its benchmark slide about 4%. Earlier in the program, we heard some tape from Bloomberg. They interviewed Charles Evans, who runs the Federal Reserve Bank of Chicago. And he was asked about interest rate policy, given everything that's on the table right now. He was a little cautious on committing to aggressive rates. We know the Fed already has committed, basically, to lower interest rates. What do you think all of this news on the economic front means for central bank policy in the United States?
Well, firstly, the most important vote on the FOMC is Jay Powell's vote. And he might get a dissent here and a dissent there, but the committee will rally around the chairman. And when you go and take a look just a few weeks ago after the FOMC meeting at his press conference and the tone in the question and answer period, there's no doubt in my mind that he is unequivocally dovish. And the Fed will be cutting rates. I think we're going back to or near the zero bound. With respect to Charles Evans, I mean, it's not even about the Fed cutting rates aggressively. What have they done so far? They've moved rates down twice after boosting them 9 times. The great experiment of pushing the envelope to gather all those bullets so that they can then fight the next downturn from a higher rate level. Well, I've got news for you. That higher rate level was 2.5% on the Fed funds rate. No other central bank around the world raised rates 9 times, starting with Janet Yellen and ending with the 4 rate hikes last year. So to tell me that the Fed's moving aggressively because they move rates twice and at the end of the month they'll move 3 times after raising rates 9 times this cycle, to me, is actually a curious statement to make. I think that the odd man out from a central bank perspective globally is the Fed, and rates are going to come down quite a bit further from here.
So this is where I think things get a little tricky for investors because, I mean, even in your own notes, given this, yes, we've seen a sell-off, but you point that we're still not that far from the all-time highs, and that is true here in Canada. I mean, we're now down, I think I said earlier, about 4% from the record that we saw September 20th. It's been very difficult for investors to assess what they should do. Yes, there are worries on the economic front. You often hear people talk about, Tina, there is no alternative. Do I want to go to the bond market and get negative returns? I don't know, do I want to put my money under the market? Is there the possibility that, tech titans like whether it's Shopify in Canada or Apple and Google in the United States will continue to rally? This seems to be the dilemma for investors, especially if, to your point, the Fed is committed to bringing interest rates down substantially.
Well, I think that what you have to do if you're investing is become increasingly thematic, and I think adopt a classic Adam Smith and David Ricardian type of scarcity value strategy. And income globally is scarce. Yield is scarce. A third of the global bond market, as you said, trades with a negative yield. So buy the bond markets that have a positive yield on their way down. I'm not saying towards negative, but buy the positive yield bond markets that are liquid, high quality. And so the U.S. Treasury market, again, stands out like a real attractive investment from my perspective. In the land of the blind, the one-eyed man is king, and the U.S. Treasury market is the one-eyed man. People say a year ago, well, what idiot would ever want to buy a long U.S. Treasury at 3%? Well, I guess only the idiot that wanted to have a 30% total return, because that's what happened in the past year.
Yeah.
And so people don't realize the power of convexity at these low levels of interest rates, the interplay between yield and prices of these bonds. So you're not going to have to hold on to these bonds for 10 or 30 years, but I would say for the next 12 months, the fixed income market, especially in the liquid treasury market, is going to be a good place to be. I think you want to be in areas where you're correlated with this heightened level of uncertainty. I say precious metals a good place to be. They are a hedge against uncertainty. I mentioned U.S. Treasury securities, a good place to be. And I think that, within the broad equity market, if you have to be long equities, stick with what works in an economic turndown. And so there's no doubt that people will say, well, the PE multiple on utilities is sky high. Well, of course, the rate-sensitive stocks get a premium multiple at a time when interest rates are declining. So whether it's REITs or whether it's pipelines or whether it's utilities, whether it's telecom, I think dividend growth, dividend yield in non-cyclical parts of the market, if you're going to be in equities, those are the places that I'd be right now.
Yeah, it is pretty amazing that we're sitting here today and I'm looking at the TSX, that you would have such strong performance from the tech group and then equally strong performance from utilities and real estate, to your point, David. Before you go, there's this common theme or discussion in the market around the idea that if President Trump, and we talked today about how now we're not talking about U.S. China tensions, we're now talking about U.S. EU tensions, that if the president wants to change the storyline, change the outlook for the U.S. economy, change the story for the global economy, he can just back away from some of this tough talk on trade, and maybe that ultimately gives a leg higher to stocks. How do you feel about that narrative?
Well, let's say, is that a narrative or is that a fairy tale? That's something like you'd read to your kids at night. That's a hope and a prayer. I think that the most important thing politically is this. It's not about what's happening to Donald Trump in this whistleblower Ukraine fiasco. It's about what's happening to Joe Biden. And then what's happening to Joe Biden, and then layer on Bernie Sanders' latest health scare. Who is going to continue to ascend is going to be Elizabeth Warren. And to me, if you're going to focus on any number as an investor today, and I say this as an economist on the eve of the non-farm payroll numbers tomorrow morning, the most important number are the daily tracking numbers for Elizabeth Warren head on against Donald Trump for the Oval Office, because she is leading in every single poll. And I think that if you are long equities, that's a pretty scary thought, because she is not the stock market's friend. I don't think I've ever seen a period, even looking at McGovern-Nixon, where the divide was so wide on the fiscal outlook from a presidential election. So I think that that's going to become, actually, more than anything else, I'd say even more than trade with China, that Elizabeth Warren's ascension through the primaries, when the markets start paying attention to this in the opening months of next year, that's going to be, I think, the real big obstacle for risk assets as we move into 2020.
Interesting perspective as always, David. Thanks for stopping by on this Thursday.
Thank you.
David Rosenberg, Chief Economist and Strategist at Gluskin Sheff and Associates.